Welcome back to our discussion on investments, and today we are going to see the investments in associate companies. An associate company is one where the acquirer has neither full control, has no control, but can influence the decisions, and the decisions here means financial and operational. An investment in the associate companies is governed by the accounting standard IND AS 28 or IFRS 28 or IAS 28. In case of an associate company, when A Limited, for example, we take this example to demonstrate the application of the investments in associate company, and A has this assets and the corresponding sources, and A acquires 250 shares at 60. So that means if you see there are 1000 shares, and out of 1000 shares A acquires 250 shares, so that means 25% share. So B is not a subsidiary of A. When B is not subsidiary of A, then B's assets and liabilities are not required to be consolidated because B is not a subsidiary of A, and B becomes an associate because A has more than 20% stake in B. In this case, no consolidation is required, and since no consolidation is required, we have to ask a question that whether equity method, which we will understand as we move along, is required to be followed even in a standalone balance sheet. Let us take it in a piece by piece manner. So the investment in associate company A Limited, the same question, acquires 250 shares at a price of 60, and suppose this is paid fully by or discharged paid by by cash. Okay, so this payment is through cash, so the discharge of purchase consideration is through cash. So post acquisition, the capital, the loan of A remains as it is, the capital remains as it is, the reserves remain as it is, but the cash will reduce by 15,000. Inventories no change, plant 12,000, and B share will appear on the balance sheet. So the B share will appear on the balance sheet. So in case of an associate company or any other investment, if you see at the in the books of A, the investments are acquired and recognized at the fair value, and the fair value is the price at which that investments are acquired. So on the date of acquisition, the recording of investment is not dependent on whether it is a subsidiary or an associate or just an investment. But at the time of consolidation or the preparation of consolidated balance sheet, you need to ask a question whether this is a subsidiary or an associate. So if I go take you back to the, so let me put it in this way. In this case, no consolidation is required, and plus A is not having any other subsidiary, so A is also not required to prepare any consolidated balance sheet. And when no consolidated balance sheet is required to be prepared, A is not required to follow equity method of accounting. So what is equity method of accounting? Let me explain that here. So equity method of accounting is used to show the investments in the associate companies in the consolidated balance sheet, okay, is used to show the investments in the associate companies in the consolidated balance sheet. Okay, and what will be the value? It will be shown at the investments according to the equity method. According to the equity method, the investments in the associate companies have to be adjusted, have to be revalued to reflect the value of the equity, of the associate company. Okay, so that is why it is called equity method. It's called equity method because in the consolidated balance sheet, the value of investment will reflect the value of the equity in the associate company. That means if the equity of the associate company increases, the value of the investment also increases, and vice versa. So that is why the method is called the equity method of accounting. The change in the value, that is the gain or the loss, is recognized as profit or loss. So therefore, to recap, the equity method is required only in a consolidated balance sheet, and we know that consolidated balance sheet is required when A is a holding company having several or one or more than one subsidiary. In this case, B is not a subsidiary and A is not having any other subsidiary. Therefore, A is not required to prepare the consolidated balance sheet. Since A is not required to prepare the consolidated balance sheet, the value of investment in the equity of B is not required to be not required to reflect the equity method, or not required to reflect the equity of B. On other word, since A is not required to prepare the consolidated balance sheet, A is not required to use the equity method to show the value of investments in B. Therefore, in a standalone separate balance sheet, investment will appear in B, which is an associate company, as just an investment, and the recognition of the changes in a value will be affected by the accounting for the financial instruments. Thank you.